Here's a number that should stop you cold. Over the last 20 years, more than 90% of actively managed large-cap mutual funds failed to beat a simple S&P 500 index fund. 90%. That's not from a blog, that's from S&P's global SPIVA report, the most widely cited scorecard in the fund industry. We'll link it below. So if almost no professional stock picker consistently wins, who does win? I'm Chris, an investment advisor at First Shelbourne in Comac, New York. Before we begin, a quick disclaimer. Today's video is for educational purposes only. It isn't financial advice or a specific recommendation, so please consult with your own professional before taking any action. Now let's get into the data. Every year, S&P Global publishes what's called the SPIVA scorecard. SPIVA stands for S&P Indices Versus Active. What it measures is simple. How do professional fund managers stack up against the index they're trying to beat? And the results? Pretty humbling. According to the most recent SPIVA data, over a 20-year horizon, roughly 90% of actively managed U.S. large-cap funds underperformed the S&P 500. Now, people often observe that this isn't because fund managers are bad at their jobs. It's a structural problem. Active funds carry higher expense ratios, they trade more frequently, and every trade carries a cost. These costs compound against you the same way returns compound for you. The data indicates that the average actively managed fund charges somewhere between 0.5% and 1.2% per year in fees versus many index funds that charge 0.03% to 0.1%. That difference sounds tiny. Over 20 years, it really isn't. Now, here's something that doesn't get nearly enough attention. One of the most powerful things about a broad index fund isn't just the low fees. It's that the fund almost never has to sell. And that matters enormously for one very specific reason: taxes. When an active mutual fund manager sells a winning position inside the fund, that sale can trigger a capital gains distribution. Even if you didn't sell a single share of your fund, you could still owe taxes that year, just because the manager made trades inside the portfolio. So that's the part people don't see coming. Index funds, by contrast, have extremely low turnover. They aren't making active decisions to buy and sell. They're just holding the market. And because they aren't selling, they largely aren't generating taxable events. Investors often describe this as tax deferral through inaction. It sounds almost too simple, but the data backs it up. Every year you don't sell a winning position is another year that gain stays invested and compounding. The government eventually gets their cut, but the longer you can delay that bill, the longer your full pre-tax balance is working for you. Think of it this way. The selling decision is one of the most tax-costly decisions in investing. Index funds that take the decision almost entirely off the table. And for long-term investors, that structural advantage compounds quietly year after year after year. Now, there's one more structural edge worth understanding: how index funds weight their holdings. Most major index funds, like those tracking the S&P 500, are market cap weighted. That means the fund automatically gives more of your money to the companies that are actually growing. Apple, Microsoft, Nvidia, as they've grown, the index has naturally increased its exposure to them. Not because a fund manager made a call, but because the math of the index itself does it automatically. And I'm not recommending these stocks, but just showing how money flows through these indexes. And the flip side, companies that are shrinking or failing, their index automatically reduces their weight. No manager needed. The market does it in real time. Many often observe that this creates a kind of built-in momentum. The winners carry more weight, the laggards carry less. The index is constantly self-editing, and you don't pay anyone to do it. It's actually similar to how the best card counters in a casino operate. When the deck is running hot and the odds are in their favor, they increase their bet. When the deck turns cold, they pull back. They aren't guessing. They're letting the conditions tell them how much to have on the table. A market cap weighted index does the same thing. It's automatically betting more on what's working and less on what isn't. Now, I want to pull back the curtain a little because I think this is genuinely useful for people to hear. At my firm, I rarely buy individual stocks for clients. And that isn't because I don't follow individual companies. It's a deliberate choice rooted in risk management. Instead, the data indicates that capturing a sector move without taking on risk of any single company is often a more disciplined approach. So historically, what I found is that sector ETFs allow me to do exactly that. Here's what I mean. Let's say a certain sector collapsed due to some sector-wide problem. Rather than picking one stock and hoping that specific company executes perfectly going forward, I can buy an ETF that holds an entire basket of companies in that sector. If the sector moves, we participate. But if one company in that basket misses earnings, has a CEO resign, or gets hit with an accounting allegation, we don't have a catastrophic exposure to it. The other holdings in the ETF absorb that single stock risk. It's the same core logic as indexing, diversification as a structural advantage applied at the sector level. And because ETFs are exchange traded, they tend to be very tax efficient as well. Just like broad index funds, they don't generate the kinds of internal capital gains distributions that actively managed mutual funds do. So when I'm building portfolios at First Shelbourne, the question historically isn't which stocks do I like, it's where does the data suggest there's a sector level opportunity and how do I capture it in the most risk managed, tax efficient way possible. If you want to dig into the SPIVA data yourself, the link is below. Drop your questions in the comments. I read every one. I'm Chris from First Shelbourne. I'll see you in the next one.